U.S. hiring trouncing expectations. The big question, is this a sign of growth or a sign of a lot of inflation the Fed's going to have to fight? For more, we bring in Nancy Tengler, Laffer Tengler Investment CEO and CIO. Nancy, thank you so much for being here with us. You had a great note that was really informative for me heading into the jobs report, so thank you for that. But I want to get your take on it because you noted that we are starting to see some cracks, particularly in the lower end consumer, with personal savings starting to not keep pace with the wage increases that we are seeing here. We're seeing these cracks come up in consumer earnings as well. So I'm curious from your perspective, when will the cracks in the lower income consumer start to cause a problem, not just for the Fed, but for markets?
Yeah, Madison, thanks so much for having me. I think this is a slow decline. And, we got the numbers today that show average hourly earnings up somewhat and revised upward, but these numbers get revised dramatically. And so you have to pay attention in the near term. And so you have to pay attention to the long-term trend. And what we're seeing is that average hourly earnings have declined to about 3.9 to 4, depending on which number you're looking at. Personal savings rate is down now to 3.6, which is well below pre-pandemic levels of 6.1. So sort of taking out the COVID checks that popped up personal savings. And then access to credit is declining. And so I think what we've seen in retail is a tale of two cities. The lower end retailers, ex Walmart, and there's a reason for that, have really shown difficulty in hitting their numbers. But then you have a name like Chipotle, which continues to delight shareholders, and we're one of them, with price increases, but also cost management and then growth. And so you really do have to pay attention to which retail company you own, because the consumer low end is getting crunched by inflation pretty severely and by higher mortgage rates.
Nancy, I'm curious, before we dig a little bit deeper into some of your positions and your views on particular stocks, if we just take a step back here and take a look at the market's kind of whipsaw reaction to this print. We have the S&P and the NASDAQ still in negative territory, but now you actually have the Dow back trading above the flat line. I'm curious just to get your take on this almost whipsaw event that we have seen here in the markets, and maybe the downside losses that we saw shortly after the print. Was that a bit of an overreaction?
Yeah, Shauna, I think when you're looking at these things minute by minute and day to day, the algorithms in the hedge funds have an outsized impact on the markets. So what you see typically is you get these violent swings, and then the institutional investors, ex hedge funds, are come in and look for opportunities. I mean, we like the volatility that the hedge funds create because it gives us an opportunity to step in and take positions at a more reasonable price. So that I wouldn't pay attention to the violent swings in the day-to-day levels. I would pay attention to the long-term trend. And we are in a bull market, and I think we'll continue to see stocks at the margin go up over the medium term.
Nancy, this brings me to your commentary about hedge funds piling into NVIDIA in particular. If there's opportunity to go against the grain of hedge fund movements, where is the opportunity when they're piling into a name like NVIDIA that's driving this market rally? How do you kind of follow that wave, but also find areas of opportunity outside of it to gain an edge?
Well, it's not easy, Madison, but what we saw from Goldman Sachs was that the last week, selling in technology was the worst than it had been in 11 weeks, which is still a very short time period, right? But and it was 60%, the selling was 60% in software. And so what we've been doing is looking for some of the higher quality names that we own and looking for opportunities to add to those. And so that was why I suggested in my notes that even though it's an obvious name, Microsoft is interesting to us here because it has underperformed year to date, the most of the names in the Mag 7, and it gives you an opportunity to pick away at a company that we think is going to be an easy winner in AI and is going to benefit from AI PC upgrade cycle.
And Nancy, I believe that you're also seeing some opportunity within Amazon as well. So is that a similar investment point? Is it all about AI? Is it all about the growth there? Or what is it about Amazon maybe that you also find attractive at these levels?
Yeah, so Sean, both those names are hyperscaler cloud computers. Mm-hmm. And so cloud computing story, sorry. And so what we saw last quarter was that Amazon, the big gorilla, was up about 17% last quarter year over year in terms of cloud computing, and Microsoft's Azure was up 31%. So when there's all this debate going back and forth about whether or not who's going to benefit from AI, we think that both of these names will be winners, and so you want to be positioned in both. Plus the other aspects of Amazon, ad growth, the retail side of the business, and Amazon Prime Video, we think it will continue to be drivers of growth. Andy Jassy is really, when he stepped in, he got what we called Tim Cooked. There was, a lot of doubt about whether or not he could run the company, as there was with Tim Cook at Apple when he took over. This is what happens when you follow an iconic CEO. But in general, we think he's done an excellent job, and the company is poised for growth.
I want to end, Nancy, where we started by taking a look at the macro. The Fed is telling us that they're going to respond aggressively if we do start to see evidence of a potential significant slowdown. I don't know that the market is necessarily priced for that potential risk. You tell me, but how should investors be positioning themselves to hedge against that potential risk of the Fed moves against any potential recession elephant in the room?
Yeah, Madison, I don't see it. I mean, I think yesterday was instructive. We had a very bizarre press conference from Christine Lagarde at the ECB. They cut rates, but they raised their inflation forecast. I think the central banks around the world, we got a cut from Canada, and we've seen some in Europe from Sweden and Switzerland. They want to cut. They believe that maybe they're restrictive more than maybe the rest of us do, but they want to cut. So I don't think we're going to see a hike from the Fed. And I've drawn an analogy for about a year now to the 1990s, where you had productivity saved the day, and Fed Chairman Greenspan understood that. And so he did cut rates 3 times in 1995 after raising aggressively in 1994, and then held them constant. So I'm not saying we're going to get 3 cuts, but I think the odds are that we get a cut rather than a hike, and it will be later this year. And I think investors are also, I think that's why you saw the market to some extent come back, because this notion that we're going to get a hike, I think, is not well founded.
Well, Nancy, since you bring up the ECB, I'm curious, we saw that folks maybe weren't anticipating the idea that the ECB could be one and done, at least for the short term in terms of cuts. What is the potential risk of that being the case for the Federal Reserve, that we're all anticipating this potential cut, but then they might cut and then wait for a long time to do another one?
Yeah, I think that's entirely possible. And I don't think that's necessarily bad for stocks at all. And what we saw in the 90s was higher interest rates and robust stock returns could coexist. I was managing money then, so I remember it very well. I didn't just read about it. And so I think that's one of the things that investors maybe are starting to sniff out. And in particular, technology companies, and the 2 names I mentioned to you, are beneficiaries of higher interest rates because they have a ton of cash on their balance sheets. And so their interest income has grown dramatically over the last couple of years. So I do think there will be losers in this environment, but there are plenty of places where if you're paying attention and picking, high quality companies, you can outperform and enjoy nice returns in this environment.